Hello everyone, welcome back to this class. So today's topic is about how to value your company. This will help you understand how much equity you need to give to your investor in exchange for the cash, the inflow, the investments that they're making into your company. So let's have also a sort of summary of what we have discussed in the previous classes. So you need to understand first how much capital you need. So how much capital are you asking your investors? And these will come from the cash flow projections that we had done in the previous classes. So for example, if you have a cash shortfall of $100,000 in year one, $100,000 in year two, and $100,000 in year three, but then in year four you will be cash flow positive, you only need to cover the first 3 years. Of course, you can fundraise every year 100,000, or you can fundraise 300,000 at the beginning, and then use this cash to help you over the first 3 years until you are cash flow positive. So you have 300,000 cash or investments that you need. The second step is review potential investors. So what is the best way to fundraise this capital? The first classes we have discussed business angels, venture capitalists, crowdfunding, initial coin offerings, whatever you think is the best way, just identify it and plan your actions toward this fundraise. So you need $300,000. For example, you think this venture capital is the best investor for your company. So now you need to value your company. So how much is it worth? Because of course you want $300,000, but you need to give something in exchange. And so by comparing these two numbers, you know how much equity or how many shares, what portion of your company you are giving your investor in exchange for the $300,000. And these last two steps will be covered in the next slides. So first, how much is your company worth? There is a number of ways in which you can do it. And one way is to compare yourself with similar companies. Another way is called the venture capital method. The venture capital method is a little bit more complex because you need to assume your value in the future, maybe in 5 to 10 years, and then discount it to today's value. That's a little bit more complex, and we are not covering this yet. So let's look at this valuation, which is looking at comparables. And so comparables means companies that are similar to you in a number of ways. For example, they're in the same industry, they have similar development stage, so they are very young, or maybe 2-3 years old, or maybe older. They have similar revenues compared to yourself, maybe similar location and type of product. Because of course, if you're selling biotechnology products, you cannot compare yourself to a company selling cars. So it needs to be similar. You can find information in a number of places, just Googling it. There's some websites that are targeted for early stage companies such as TechCrunch, Crunchbase, Angel.co. These will give you some information. So just Google fundraise company biotechnology valuation. You are likely to find some information of companies that have fundraised. Of course, there is also a lot of variation by country. So if you are located in New Zealand, the valuation that happens in the US are probably a little bit different than the valuations that you can expect in New Zealand or in India or in any other country. You might want to look also at the venture capital or business angel associations. For example, in New Zealand, you can look at the NZIF website, or in the US, NBCA website. So for example, this is a screenshot that I've taken from the New Zealand Investment Fund, and it provides you some comparable valuations. And they're divided by stage and by industry. So for example, if you look at here, these are startups which are a bit older than seed companies or proof of concept companies. So here you're probably looking at companies that are 1 to 2 years old. And you can see that the number of investments, so for example, in software, there have been 118 investments, and the median valuation has been 2.5 million. So you see software and services, 2.5 million for startups. If your company was even an early stage in software, was 1.2 million. If it was a proof of concept, was $500,000. So this just gives you a general understanding of the pre-money median valuation. Here you have the average valuation. You can choose between the two. They're probably not very different, especially if they are larger numbers. Here you can see just by stage and median and average. So overall, imagine you're launching a startup and you're just very early stage, maybe you're just a business plan, you can expect a pre-money valuation of $500,000. So this is a good understanding of where you are looking at. From these numbers, you can apply some adjustments. Of course, these adjustments should not be wild. If the average valuation is $500,000, you shouldn't add all these numbers and say, well, my company is worth $5 million, unless something exceptional happens. So for example, if you already have a product and the other companies don't, you can say, okay, I'm worth a little bit more. If you have a prototype and the similar companies don't, you're worth a little bit more. If your company is run by Elon Musk, maybe your company is worth a lot more than other companies. So here it's just an indication, $500,000 more, it can be just a little bit more, it may be much more. But whatever adjustments you're making, it needs to be significantly justified. Don't just add as much because otherwise your investors will be put off. So the idea is be similar to similar companies, adjust a little bit, but unless there is a strong reason, that should be your valuation. It can also be adjusted downward. So if you find two companies very similar, for example, in the US, you need to adjust downward. For example, if you are located in New Zealand, your valuation is probably be 1/3 of what the same companies in the US would achieve. Once you have the valuation, this is your pre-money valuation. The difference between pre-money and post-money is simply the investment. So for example, from your cash flow projection, you want to raise $300,000. You're looking at the comparables and you think, my pre-money valuation is $750,000. This means that your post-money valuation is 750 plus 300 means 1,050,000 valuation. Okay, so post-money valuation is your pre-money valuation plus the investment. So the word says pre and post. So post is pre plus the money that you're receiving. Once you have your post-money valuation, you simply need to divide your cash injection divided by your post-money valuation. So in this case, you're going to give your investors 28.6% of your company in exchange for the $300,000. The reason why we use a post-money valuation is because in a startup, usually the cash is not given to the entrepreneur and the entrepreneur goes and buys a new car or a new house, but the cash is in the company to develop the company, to continue the business. If you were to keep the money out of the company, the calculation will be based on the pre-money valuation. But since this is a cash inflow, is an investment into the company, you use a post-money valuation. Online, I will put some quizzes and some exercises so that you can practice your understanding of this concept. And with this slide, we finish today's class. Hope you have enjoyed. I'll see you at the next time.